Many experts, gurus, and economists have predicted a worldwide market collapse and dollar collapse, as well as a failure of the whole global economy since 2018. In the past, hasn't Dalio been predicting this collapse? As long as the retail investor extends the time horizon to many years to come, they will be able to forecast the next crash. Investors are using low-cost borrowing as a means of investing. In the worst crashes, this occurred in abundance. It is most likely to happen again. The longer you've been in the market, the more critical it is, yet prices are at all-time highs. Buying the dip is now mandatory. In the long run, they would be correct. Shouldn't stocks rise now that inflation is high and is likely to stay that way for at least the next 2 to 4 years? What's the point of keeping your money in cash if you're losing 7% a year? If you are new to our YouTube channel, please subscribe and click the notification bell to avoid missing new content. Dalio Association will regularly add videos to keep you updated on the latest in business and finance. The entire economy will crash, Ray Dalio. We addressed how to prepare for hyperinflation in our previous video, where we outlined main factors to consider, including the following: determine how far your savings will go, diversify your investments, and don't try to time the market. Ray Dalio started Bridgewater Associates, now the world's largest hedge fund. He is renowned for his macroeconomic expertise and for creating the concept of risk parity investment. Dalio has long been famous for his conviction that there are better assets to hold than cash in the face of central bank money creation. Unless you have been a financial lookout past several months, you must be aware that the Federal Reserve has been printing copious amounts of money. Finally, this money creation has enhanced financial assets globally, creating unprecedented. The Federal Reserve has captured the financial markets. According to Bridgewater Associates founder and CEO Ray Dalio, Dalio is a macroeconomics expert who has successfully handled $150 billion in assets over the previous 2 decades. Due to Dalio's renown for economic insight, this is not only a trap for the Fed, it's a trap for regular investors like you and me as well. This video will discuss these events in depth and how the Fed ended themselves in such a pickle. Market breakdowns are almost impossible to forecast, and we are not here to spread fear. That being said, our current status is peculiar, and the unfolding events will have far-reaching effects. During the previous few months, the Federal Reserve has imposed significant levels of quantitative easing or buying massive amounts of debt. Bond prices have been artificially inflated as the government's purchasing power has expanded. Bond prices and yields are, as you may know, inversely connected. Bond rates must fall with bond prices. Bond yields must rise when bond values fall. As a consequence, bond rates have been artificially lowered. About 1.5% is now being paid in interest on the 10-year Treasury note. On the other hand, inflation is easily far more than 2%. In other words, although bond investors may assume they are still profiting, the fact is that they are losing money. Nominal returns or returns before inflation are positive at 1.5% per year, while actual returns or returns after inflation are practically negative. Consequently, bonds have devolved into a parody of a financial instrument. The Federal Reserve should sell some of its bonds immediately to solve artificially high bond prices. We've already seen the start of this. Indeed, the Federal Reserve has begun selling corporate bonds and corporate bond exchange traded funds or ETFs that it bought at the pandemic's height. The Fed has begun to hint at the potential of reducing bond purchases. You might believe that the Fed is winding down its bond purchases based on facts. On the other side, Ray Dalio feels the Fed is in an altogether different situation. Rather than sell bonds, he believes the Fed will soon be compelled to purchase them. That may appear absurd at first glance, but it makes a great deal of sense upon closer examination. As previously stated, bonds are not particularly attractive at the moment. To be conservative, large institutions have accumulated government bonds, which is one of the reasons bond prices are so high. If the epidemic worsens, these institutions will continue operating by selling the bonds. If these massive institutions and investors begin selling bonds to invest in other financial assets, such as domestic stocks, real estate, and international equities, bond prices will fall. This is because no one wants to buy bonds at current inflation rates, as they guarantee actual negative returns. On the other hand, other financial assets can generate significantly higher returns. To avert a bond price collapse caused by the selling power, the Fed will purchase bonds, thereby artificially increasing the money supply. On the other hand, every day, week, and month, a tragic collision occurs. "I warned you," they say when it happens. In the meanwhile, the stock market has risen. The Federal Reserve will determine whether everything falls or if it continues to be pushed upward, how long it stays upward, and for how long it remains upward. The market will remain robust as long as investors buy bonds and investors' sentiment remains favorable. If any of those two things fail, there will be a crash. Items are fragile in my perspective and may change on a dime. If you opt to play on the edge, put stop-loss orders and rebalance your portfolios when the market begins to move. A lack of trading discipline must often cause us intraday trading losses. According to statistics, around 80% to 85% of intraday traders lose money in the stock market. While defeat is an unavoidable part of the game, this does not imply you should surrender. While U.S. demand for Chinese commodities may increase, China is also experiencing supply constraints, notably in the food and energy sectors. This implies they will also have to import goods and spend money to compensate for the shortages they have frantically attempted to conceal from the public. I believe that the balance of payment surplus will not persist indefinitely. Finally, how many individuals do you think will invest in Chinese firms at the moment? It is a risky move since we are aware that the CCP may take such assets or prohibit the firm from doing business at any time. Please share and like this content and let us know what you think by typing your comments below. Keep your notifications open and I'll see you on our next video.